All right, welcome to This Explainer. Today, we're going to fundamentally rewire how you view the banking sector. Seriously, if you've ever looked at a bank's financial statements and just felt kind of lost in this massive sea of percentages and ratios, well, you are in the exact right place. We are going to focus entirely on the absolute most crucial preliminary step of stock analysis, which we call Step 0. It's the foundation for literally everything that follows, and mastering it will completely change your perspective on investing. So let's dive right in.
Section 1. The biggest analytical mistake? Skipping context. You know, so many amateur analysts fall into this super dangerous trap. They jump straight into the spreadsheets and the profit margins the exact second earnings are released. But before you force a conclusion, you have to stop and ask yourself a really profound question. Do you just assume all banks operate under the exact same rules? Like, do you assume a bank is just a bank and money is just money? Because honestly, if you do, the market is going to take advantage of you.
The crucial point is this. Before you touch a single number, you absolutely must identify the exact type of bank you're looking at. Analyzing a bank's metrics without knowing its type is, well, it's a lot like trying to judge a fish by its ability to climb a tree. Context is everything here. If you don't know the specific rules of the game being played by the institution you're analyzing, every single metric you pull is just going to be meaningless.
Section 2. Identify the bank type and adjust your expectations.
Look, the banking sector isn't some single uniform monolith, right? It's a highly diverse ecosystem made up of completely different species of financial institutions, each with its own habitat, survival strategies, and operational realities. You have to categorize them immediately. Are you dealing with a massive public sector giant, a large private bank, maybe a niche small finance bank, or a microfinance lender? These aren't just fancy marketing labels. They literally dictate the financial physics of how that specific bank generates returns.
Moving to Section 3, who are the borrowers? Because risk dictates returns.
To truly understand a bank's segment, you can't just look at its corporate structure. You have to look at the other side of the equation. Who is actually borrowing the money? Is it everyday retail customers trying to get mortgages, massive corporate infrastructure projects, maybe farmers needing microfinance in rural areas, or small business owners requiring working capital? The borrower dictates the risk, and the risk dictates the returns. Each of these groups behaves completely differently during economic cycles.
Section 4. Why benchmarks shift completely. The rules change by type.
Because of these drastically different borrower profiles, you just can't use a universal yardstick. The benchmarks used to judge a bank's health shift entirely depending on its type. Let's look at one specific metric, the net interest margin, or NIM, to see just how shocking these baseline expectations can be from one bank to another. This is the core spread between what a bank pays for deposits and what it earns on loans. It's the absolute engine of their profitability.
Let's say you're analyzing a massive public sector giant, and you see a net interest margin of just 3%. At first glance, you might think, that sounds kind of low. But in reality, for that specific type of institution, a 3% margin is considered entirely healthy and normal. It means their massive, standardized lending engine is humming along exactly as it should be.
But, and this is a big but, imagine taking that exact same 3% expectation and applying it elsewhere. If you see a 3% net interest margin at a small finance bank, it is deeply alarming. For a small finance bank, you should expect a margin somewhere between 6 and 9% just to justify their business model. Actually, scratch that. If they're only pulling in 3%, something is terribly broken.
And the exact same logic applies to the health of the loans themselves. You are going to see violent asset quality swings at a microfinance-focused lender, simply because their borrowers are far more vulnerable to economic shocks. You have to contrast that with the relative stability of a corporate-heavy private bank. If a corporate bank showed the volatile swings of a microfinance lender, no way. That would be a massive red flag.
Which brings us to Section 5, the golden comparison rule. Compare against peers.
This right here is the absolute law of banking analysis that professionals swear by to avoid being fooled by flattering headlines or, panic-inducing clickbait. You must compare a bank only against its own peer group and never across types. It is a fundamental error to compare the margins of a small finance bank directly to those of a public sector bank. It's a completely invalid comparison that's honestly just going to lead you to make poor investment decisions.
Finally, setting your realistic baseline, the output of Step 0. By actually completing this crucial step 0, by just stopping, categorizing the bank, and understanding its borrowers, you build your armor for the rest of your financial analysis. You're establishing context before you even glance at the quarter's actual performance data, determining what is actually normal for a bank's margin, its growth, and its asset quality.
The output of this essential step 0 gives you 2 massive advantages for every single financial metric that follows in your analysis. First, it gives you a clear peer group for fair comparison. And second, it provides a realistic set of expectations. You now know exactly what good and bad actually look like for this specific institution.
So, before you run your next stock analysis, or before you react to the next flashy financial headline, take a hard look at your own portfolio. Are you comparing apples to oranges? Or worse, have you been skipping step 0 entirely? Once you get the context right, what true story will the numbers finally reveal to you? Thanks so much for joining me on this explainer, and happy analyzing.